Jyoti Vardhan Jaipuria is now joining us live. Jyoti, good morning. Thank you so much for taking out time for us. Could you just tell us about 2017? There are a lot of global and domestic triggers which will keep markets volatile.
Yeah, there are. So, I think it's more global than local. So, we of course have a change in the US presidency. I think we have a change in the monetary policy over there. And probably the hope is with, a change in US presidency, we'll have a change in the fiscal policy over there. So, that's one thing to watch out for. I think the bigger issue is in Europe and, in Britain because now we'll have Brexit actually happening. So last year when Brexit got decided, markets got nervous, but then, it just seemed like it's far off. So this is the year where Brexit actually will happen. The contours will be worked out, and I think that will be one thing which market will have to watch out for. The other is there are lots of elections in Europe. So, in general in Europe, the anti-EU parties are gaining strength. And we have to see whether, some of these major countries, we see them actually coming to power. So far, it doesn't seem likely, but, if we take 2016 as an example, most of the time politics have thrown up something which is different from what the market was expecting.
Right. In terms of domestic triggers, earnings have to grow. Last 3-4 years, earnings have missed street estimates. There was a constant sort of a decline. Demonetization, rate cuts, or whatever is the domestic cue, whether GST or no GST, you think earnings have to grow and that's the only thing which will get confidence among investors?
Yeah, so, in any market, earnings has to grow. That's the best way to get, markets moving. In India, I think right from 2008, we've seen earnings, just missing estimates. Earnings starting very strongly. When you start the year, there's a lot of high expectations. And by the time you end the year, it's another, single digit earnings growth. And we move on to the next year with same estimates. I think this year again, we are faced with a similar situation in the early part of the year where I think earnings will see downgrades. We've had the effect of demonetization. If GST comes, that will probably be near term another reason for downgrade of earnings because, there'll be a lot of volatility around GST. I think there'll be destocking of goods earlier just before GST starts. A few months into GST, there people may be trying to get their feet on the ground. I don't think corporates are fully ready for GST. So, demonetization plus GST could mean earnings in the early part of the year still remain weak and see downgrades. Probably, once we move into September, October of this year, which is right to the fag end of the year, that's why we should have earnings looking good because, you have a very poor base to contend with. And by that time, hopefully things have normalized on both the demonetization and the GST front.
Right. In terms of Q3 numbers, Q4 numbers, you think markets have already discounted that numbers would be weak?
So I think, we are starting Q3 knowing that the numbers are not going to be very strong. They're going to be a weak set of numbers. So the expectations are for, really low single digit type of growth. What one has to see is whether the impact of demonetization is even more than what people are estimating at the moment. And that is the risk that, some of the companies probably end up doing worse than what people think. Because, when you do these estimates, the thing is you always tend to underestimate the downside, you always tend to underestimate the upside also. So to that extent, maybe by the time we end the earnings season, we would find that, we'll still get some downgrades. Even generally, if earnings come in line with what analysts expect, I think, we'll see downgrades for the next couple of quarters in the earnings estimates.
Right. And is that something which markets has factored in or for FY18 still earnings estimates are optimistic?
I think FY18 is still optimistic, so we'll probably see some downgrades coming through. What typically tends to happen is, analysts pay a lot of attention to the current set of earnings, and for next year they built in that things will get back to normal. I think as we move into FY18, we'll start seeing downgrades coming. The timing of the GST is still not known, but I think, that will be one pain point for earnings near term. It will lead to some downgrade around the time that the GST actually kicks in.
Right. And in terms of budget, you expect there can be a rally into the budget?
So, I think if you see now, the market has actually rallied from its lows quite a bit. So, we've had a nice small rally which has come through. I don't think we should see a major pre-budget rally because ultimately the ability of the finance minister to give too much softs which the markets want are limited. It's not like he's raised too much money from demonetization by way of cancellation of notes. Taxes have been buoyant, but not really being so buoyant that we are going to get into a scenario where he has a lot of money to roam around. So I think, it's going to be a bit of softs. He'll give, some softs for the rural poor, some softs to the lower tax paying bracket, but it's not going to be dramatic enough to change the course of the economy. In fact, the one thing which we have to watch out for in the budget is the taxation on the capital market side. So there's been a lot of talk where we may get hit with either long-term capital gains, the 1 year changing to 3 years, some higher taxes on the short-term side. So that's something to watch out because the market could get disappointed with that.
Do you expect changes into long-term capital gain tax?
So, the finance minister said that there's no plan to tax the long-term capital gains tax. At the same time, if we look at all the statements coming through, they are looking at having some taxation come in. So possibly what we may see is that the 1 year limit for long term may become 2 years. So, the time frame may be changed and the taxation may be kept at zero.
Right. And say if there are any major changes to the long-term capital gain tax, do you think market is already prepared for it? As even last year going into the budget, there were some signals regarding long-term capital gain tax. This year also there is some noise, as you have said. So are markets prepared for it?
So, market like somewhere senses that something like this can come and it always keeps hoping it does not come. So last year when it didn't come, we saw a rally in the budget that, okay, it's not come. So markets rallied quite a bit. If it comes, then you can see the opposite reaction that, oh God, this has actually come. So somewhere, market is building in a bit of fear, expecting it. But I think if we really get something which is dramatically different, we could see market sell off a bit.
Say if the budget is slightly on the expansionary side, do you think markets would be disappointed in terms of higher fiscal deficit?
I think not. There are a lot of economists who want to stick to the, fiscal consolidation plan. But I think if we see in India at the moment, we could do with a bit of fiscal expansionary, even risking a bit of inflation, risking fiscal consolidation, because inflation is under control. So inflation is not a threat at the moment. Growth has slowed down because of this demonetization. Second is, if we see, I think this is going to become the trend globally. I think we are going to see fiscal expansionary policies because growth is a missing element. And so, I guess the US is already talking about it. Probably some other countries will follow suit. So we are going to see a trend globally. So to that extent, we probably could do with a slightly higher fiscal deficit for this year, as long as that money goes, into productive use. So that's the key thing, that, if you're going to have fiscal deficit which is higher, then, that extra money should go for investments.
And whenever there is a interest rate which is on the lower side and growth is lower, if low interest rates and stimulus is given, growth could recover faster?
Yeah, so, if we get that stimulus which goes in the right direction, interest rates are low, stimulus is low, what you've done is you created an enabling environment for growth to pick up quickly. Because, there's so much you can do. It's like you can take the horse to the well, but you can't make it drink water. So you've created all the enabling environment. And so to that extent, you have to assume that at some point the growth will start picking up.
Right. In terms of some of the sectors, let's start with private sector banking names. Initial numbers from IndusInd Bank, from DCB Bank, even from some of the housing finance companies that we got yesterday. Numbers don't necessarily indicate a very big slowdown, which the street was factoring in earlier.
So I think that the private sector bank should be okay. I don't think we're going to see something very dramatic happening. But what we've seen so far is more the, retail lending side. We've not seen the corporate lending side. So I think the stress will come in some of the corporate banks where, we could start seeing another fear that NPLs may start coming through, because earlier the whole thinking had been we are probably bottoming out on the NPLs. So, whatever stress there is in the SME sector, in the other sectors, that will be felt probably in the corporate banks rather than in the retail-focused banks.
But don't you think that even corporate banks would see, normal business growth to continue? Retail was also expected to slow down, but it has not.
Yeah, so there are two things, right? One is is the growth continuing on the lending side, or essentially most people what they are seeing is your deposits have been a lot. So to that extent, your funding costs have come down quite a bit, and that you'll see in the corporate banks also. Second is, but where the pressure may come is where the NPLs start to show a uptake, or they start getting a little more nervous on the NPLs than what they were a quarter ago. So that is what the market could get disappointed with.
In terms of NBFCs or microfinance companies, anything that you like?
So we've still stayed away from this. A lot of these names have corrected quite a bit if you see after the demonetization, but they had a really sharp rally, before that, like right from March, April. NBFCs really went up, so we still don't find things which are very compellingly cheap over there. So they've become cheaper than what they were, but we're still not finding okay, this is crazily cheap and we have to buy it. So there are some names we are studying, but not really buying anything so far.
Right. And, overall in terms of NBFCs, there can be much more problem with banks because, the sort of way in which they operate, the areas in which they operate, cash was quite a significant component versus where banks operate.
Yeah, so that's the issue with NBFC, especially the more microfinance type of companies, that cash was, used in most of their lending, most of their, loan repayments were in cash probably, and to that extent there was a hit on them. Near term, they have come under pressure. What you have to see is longer term, does it help them or not? Ironically, you could say that it will help them because, even the money lenders against which they compete, the unorganized people who give money to that same segment of population, they are also under pressure. So to that extent, you could say that longer term they'll get benefit, but near term they are definitely going to get hurt, and to that extent, the market's been also a bit concerned about it.
As far as some of the other sectors are concerned, like IT, where valuations are pretty attractive or lower than the 5-year average, do you think that one can tactically go overweight on them, especially after results and the disappointment, or still you would wait for the management commentary to turn positive?
So, our view on IT is we don't really like IT over the 3-year, 5-year period, because our view is it's become one of those more mature industries where growth has structurally slowed down in the sector. So it's something which is like a slow growth, low valuation type of sector now. But near term, we've been playing it just as, it's an underowned sector, it's an underperforming sector, and it's a cheap sector to that extent in a market which is very nervous, where growth itself is not a plenty. It's something which probably can outperform the market.
And how would you tactically place yourself in IT? Would you be overweight on the large cap, mid cap IT space?
Yeah, so it's more like what you're playing is, I think the markets are going to be nervous, markets are going to be weak. So where do I find, things outperforming? And IT is one of the spaces. Basically, a lot of the global stuff is something which could outperform at a time where domestic growth is slowing down. So, it's like, a mix of large cap and mid cap names, which we probably prefer more of the mid cap than the large cap.
As far as IT is concerned, even in the large cap space or index as a whole, downside is limited from here on?
Yeah, so, the downside is probably limited. In a falling market, it should outperform the market. If we get recovery back in the economy, then it's not something you really want to be playing with. So what you're playing this is, as a tactical thing that just now the recovery is a bit of question mark. Things have got pushed back. And to that extent, I'm trying to find areas which I think are safer, and so I'm holding IT for that.
And in terms of pharma, valuations are not very attractive, or it has to be a case-by-case analysis?
Yeah, so like a lot of the big pharma are getting hurt with this FDA, but in pharma, it's still possible to find some of the smaller companies. There are lots of niche players there, which will show quite strong growth over the course of the year. And so, there are some names like that which you can always find in that whole pharma pack. So that's something which, on a constant basis we evaluate. We change the stocks which we own, but we, like that sector.
Right, but one has to focus on mid-cap companies where US business is not that big, but approvals are coming in. So US business could become big, or any other big destination like Europe also could become big.
Yeah, so that's why, pharma is a little more unlike IT, where, probably most of the companies are very similar in what they do. Pharma, there's a whole variety of companies you can find. So, and, each company is at different points in the FDA cycle and sort of clearances which they're getting. There's some companies which, over the next 1 year, there are a few first to file approvals which are coming through. So that's the way we really play. It becomes a little more bottom up rather than, top down. Whereas IT is a little more top down, that you're playing it for just this reason that I don't like the market. But yeah, in pharma, like you said, you can find companies which are just, getting into the US, or, there are some approvals which have come through, so they'll do well in the US over the next 12, 18 months. Maybe, some emerging markets are doing well. So that's the sort of companies you can find in pharma. And it gets a little more bottom up in terms of stock picking.
Any way to factor in the US FDA risk for any company?
So, it's very tough to factor. So, it's a risk which you have to keep as a macro, that at some point, we could see. Like what we see, that most of the companies have gone through some bit of problem. The one thing you can figure out is when was the last inspection, and so when is like the likelihood of the next inspection coming through. So if there's some time gap, if somebody just got his inspection done very recently, then you would generally think that, okay, next 2 years I probably am a little safe from that sort of risk coming through.
Mid-cap index has done particularly well. Any view on the mid-cap space? Do you think that the mid-cap space can continue to outperform?
So, my view is that near-term mid-caps may struggle. There's actually better value in the large-cap near-term than it is in mid-cap because of two things. One is, because the mid-cap index has done so well, it now is a little more expensive than what the large-cap index is. Secondly, mid-caps do very well when the economy picks up, but the same way when the economy is struggling, then mid-caps go down much faster in terms of their earnings profile. So I think, near-term mid-caps may struggle a bit relative to the large caps. But I think over the next 2 years, given that we'll have a recovery in the economy, mid-caps will still be the place to be. So, over the next 2-3 months, when we find mid-caps correcting, I think, we would be more excited about mid-caps again. But near-term, relative to large caps, I'm a little more cautious on mid-caps.
If MF flows are strong, do you think mid-caps can continue to do well?
Yes, they can, but again, we have to see where the MF flows go also, because, just like we find mid caps a little expensive at the moment, I'm sure a lot of fund managers are also finding the same thing. And everybody looks for where they think is value and where they think there's safety. So what we may see is MFs may not, continue investing in mid caps in the same way that they were, let's say, a year ago, where, it seemed a little easier to invest in mid caps. So to that extent, you may see a bit of that tilt. The other thing is finally it's earnings, right? So if you see earnings profile going down for the mid caps, and mid caps are a little more vulnerable when things go down because, one order gets cancelled, something gets postponed, and earnings do go down quite a bit relative to the large caps. You could see that happening. But ultimately, from my point of view, this is like a bit of tactical call. So this quarter, it's like probably large caps will do better than mid caps. But over the next 2 years, I still want to buy the mid caps.
Jyoti, thank you so much for taking out time for us. Always good to get in a perspective. That was a view coming in from Jyoti Vardhan Jaipuria.